Okay, cool. So I usually like to start with contact info. Right there, if you want to, take a screenshot, that's how you reach me. If you want to send your buyers to my website, there's a ton of stuff on there,
Okay.
resource calculators, and the one that everyone's most excited about, the apply now button. So, they can apply online. It's not like a traditional mortgage application. It's really kind of tailored and smart, and it asks people questions and fills in blanks on its own rather than handing someone a piece of paper that's kind of overwhelming and forcing them to, fill in those blanks themselves. So if they have any questions, or if you have any questions, let me know. But those are the best ways to reach me there.
Gotcha.
Today, I'm speaking about conventional lending. It's, kind of not a whole lot of people teach classes on conventional lending because it's kind of the easiest one. It's the slam dunk one. It's for people with good credit. Someone who's putting 20% down gets no private mortgage insurance. PMI is what most people refer to it as. But what makes up conventional lending? What are the requirements? Who sets those requirements? There's more going on behind the scenes than people really know. They just think hey, it's a slam dunk loan program, good enough for me. So just wanted to talk a little bit more about, behind the scenes. Fannie Mae and Freddie Mac are kind of the big banks behind that. So talking about them a little bit here.
Gotcha.
Who are they? So the Federal National Mortgage Association, that's Fannie Mae. It's an acronym, FNMA, was created in 1938. It is more or less a bank that is purchasing mortgages fully backed by the US government. Federal Home Loan Mortgage Corporation, or Freddie Mac, was created in 1971, basically doing the same thing that Fannie was doing, just kind of a second bank in there to help. So I'm talking about big mortgage banks, but they don't do lending themselves. What are they doing? How are they involved? Well, they were created to provide relief to regular down home mortgage lenders in the market who were out, providing loans. Before 1938, you would have your mom and pop lender in your town who might give you a mortgage. Now, they were going to require 20% down, maybe even more. It was pretty strict. Why? It's risky for them. They're going to keep that loan on their books. They're going to collect your payments. They're going to collect the interest. It's all staying right there at home. Well, a lot of banks, especially after the Great Depression, they were hemorrhaging. They were losing a lot of money. The people weren't paying their mortgages. They were going under. Well, they needed someone to come in and kind of relieve these banks of their liabilities, so to say, to allow them to go out and issue more mortgages, do more loans. In comes Fannie Mae and Freddie Mac. They come in to basically say, okay, so you just originated that loan, mom and pop. You created this new mortgage. We're going to buy it from you. We're going to pay you a premium, so it's worth your time to sell it to us. We're going to take it off your books, and what that'll do is allow you to go out and do another mortgage. And once you do that mortgage, well, we'll show right up again and help buy that mortgage from you again. So it provides a stability there for mortgages to continue to be created, whereas in 29 on through the 30s, most of these banks just clammed up. They didn't want to do anything. They didn't want any new mortgages, and it caused a crazy 10-year recession. So there's a lot going on there. So if you have any questions, feel free to stop me. But basically, yeah.
Sorry. So I guess my only question is, so like I had the understanding that like the FHA, VA, like those are kind of like secured and kind of backed by government, So is that the same with conventional?
Kind of. So with VA and FHA, the government backs them in the event of default.
Right.
Fannie Mae and Freddie Mac are actually still purchasing those loans on the secondary market, meaning,
right.
So, cross-country mortgage, Chris Bullock, I go out and I do a VA loan. Fannie Mae still very likely will buy that within the first 60 days of closing, and relieve that off the books of cross country so that we can go do another VA or FHA or conventional loan.
Got you. Got you. So
Yeah.
they're not backed by,
Right.
they're just bought and with those mortgage-backed securities.
Yes. So
Okay.
let's say I do the VA loan, we go, it gets sold to Fannie and then it defaults. Technically, the US government is then going to guarantee it through default, meaning they'll step in and pay a portion of that loan back to Fannie Mae so that they don't, basically have to eat all of that foreclosure or default. So yeah, there's two sides of it. It's almost funny because you'll see here my note, Fannie Mae and Freddie Mac are fully backed by the US government. So it's almost like one department of the government would be paying another department of the government back. They do operate independently. That's kind of an important thing. For the longest time, Fannie Mae and Freddie Mac were truly independent corporations. But after 2008, the government stepped back in and kind of took a portion of control from them, just a bit of oversight to try and, as you can imagine, after the Great Recession, there was a lot of kickback from government officials about subprime lending and Fannie Mae and Freddie Mac purchasing these loans that ended up defaulting. So there is a bit more government oversight. Either way, they are both fully government backed. You might see that referred to in my other classes as GSEs, government securitized entity. Basically, funny enough, they're like a corporation that operate on their own. However, the government has oversight and will guarantee them to exist. So they might as well be a government entity.
Gotcha. Okay.
So this is a fun chart. Just a few weeks ago, we had a national sales convention for cross-country mortgage in Vegas. One of my favorite mortgage securities speakers was there, and he provided this chart. I was not able to make it, but Sean Hadley snapped this picture for me, and it's the mortgage cycle. A lot of people don't speak about this, unless you're in finance or mortgages, you might not care or have an interest. But the reason I bring it up, I think it's important whenever we're talking about how does a mortgage rate get created? How does the cost of a mortgage, how do they derive those numbers? It's important to see where a mortgage travels after it's closed. One of the things that is confusing, especially to buyers, is they will close on their home. 2 weeks later, they get a letter and it says, oh, well, their PNC has my mortgage now. What happened? Well, it's not actually that PNC owns that mortgage. What they did is PNC came in and purchased the right to service that loan, meaning collect the payments, manage the escrow, and they can do other things for you, like if you were to recast the loan or something like that. They're basically just saying, hey, this exists. For a fee, we're going to come in and we're going to manage the collection of payments and everything. So
that's interesting because so when people buy the mortgage from the original lender, that means that a home buyer or like an owner could potentially be paying someone else and communicating with someone else then?
They almost always will. So even let's use cross country as a really good example. Cross country mortgage has two entities. Think of it as two buildings under one umbrella. You have the lending side, which is what I operate in. I'm going to originate loans. I'm going to get your buyers from contract to close. At which point it more or less leaves my building and goes next door to cross country Doven Mule, which is our servicing side. So it's still the same website, still says cross country. Buyers feel like they're in the same company, and they really kind of are. But at that point, I don't have access to that loan. I can't adjust your auto payments. I can't take a look at your escrow. It's like basically a different company. Now we do that so that we want our name to be a splash across the whole market. We want people to feel like they're staying with our company. They are. It's owned by Ron. It's the same company. Ron is the owner of Cross Country Mortgage, but at the end of the day, it is a separate building. So smaller mortgage banks, they don't have a servicer under the same umbrella. They're not going to
Right.
be able to manage all of that, in one building. So they're going to sell that off. And, I don't know exactly who. I mean, most of the time our loans are staying within cross country, so I can't speak to what banks are using what servicers. One I see a lot is like Penny Mac. And someone thinks, well, Penny Mac just bought my whole mortgage. Actually, no. And funny enough, your mortgage is actually going to be purchased and moved several times over the first 60 to 90 days that you close. So think of servicing as who your buyers are really interested in. That's who's going to be setting up their auto payments, who they're going to send checks to, who they can call when their taxes go up to make sure their escrow is correct, things like that. However, this mortgage cycle on the screen here kind of shows you where the actual loan itself goes. And, it gets originated right here at the top. You can see borrower, beginning stage right there. The originator puts it together, the mortgage company, securitizes it basically, and issues a loan. Servicer will pay a small percentage to have the rights to collect, and then it moves to an aggregator. That would be Fannie Mae, Freddie Mac. So you see, it's moved from the borrower getting involved, the buyer getting involved, us originating, the mortgage company putting it all together, the servicer paying to take care of the servicing rights, and now it's landed with Fannie Mae and Freddie Mac. That's not its final resting place necessarily, as they will put it into what are called mortgage-backed securities. They basically, and this was a buzzword 2008 to 2010, just because that's what crashed and put Lehman Brothers under. They were over leveraged in these mortgage-backed securities. When the market fell, there goes their biggest interest in their investment firm. So how it works is mortgage-backed securities classically are some of the strongest, most resilient, I don't know what to call them, investments. It's like stock, basically. It's like investing in a stock. And what it is a bunch of mortgages, because Fannie Mae is buying all these mortgages. They're cramming them together, putting them under one name and saying, all right, you can invest in this, and we can give you a confidence level of so much. We're pretty confident you're going to get this in return. And that return is because they're collecting those interest payments. So as long as everyone's paying their mortgage, it's almost destined to continue to collect. So assuming you don't have a default or a lot of default, and you don't have a major market crash, these are pretty solid things to invest in. Because of that, Fannie Mae and Freddie Mac will sell them off on Wall Street, and they will wind up in most people's IRAs, 401ks, retirement funds. If you're buying into US equities through your 401k, a good chance is there's a chunk of that that's in mortgage-backed securities. So, long story short, that loan has started with just me and the buyer having a conversation, and eventually gets lumped into where it's someone's 401k. At which point, my company has been relieved and can start doing another loan, which continues. So you can see how the mortgage boom has, kind of fluttered over the last 40 years to be one of the biggest industries in the nation. It's a really interesting thing that I think most people don't talk to, because one, it's a little confusing, and two, your buyers aren't going to care too much. It's something I like to talk about. Now, the real reason.
Sorry,
Yeah.
I definitely, I would definitely say I appreciate that, that in-depth understanding of that. But what you just said kind of was why I asked, in a sense of for buyers. So if the mortgage is moving around, and then all the process that we just talked about, does that change something for buyers? Like if they go in and they have the understanding that they're using a specific, like you as an origination, does that later create confusion when they're no longer dealing? Like say you guys didn't have the servicer that could be under the same name, is that like a little misleading, and can that create kind of some confusion later on that they're not necessarily communicating or paying or working with the same lender that they originally chose?
Right. So there is a disclosure that they get whenever they sign a loan application, formal loan application, I should say. Now they receive a ton of disclosures. Bless the people that actually sit down and read every single one. But there's everything from the U.S. Patriot Act, the right to collect your information to make sure that you're not, buying this home as to aid and abet terrorism, all the
Right.
way to, hey, just so you know, we don't necessarily know who's going to service your loan,
Gotcha.
but someone will, and you will be contacted after closing with who will be taking care of it. So I like to be upfront with people because that is
That's
something
interesting.
they ask about for sure. I get that question all the time, and I like to say 99% of the time it's going to stay right here with Cross Country Mortgage in our
Mhm.
division of servicing Cross Country Doven Mule.
Mhm.
However, there is a small chance that it could be sold off to someone else, and we'll stand behind the quality of their service. Either way, you'll have to call some. I won't be able to manage that for you, and that's just how the industry is. There's no every loan officer basically has to have that same conversation where someone else is going to service the loan because that's just how the cycle works. Yeah, and I usually do not get this in depth with buyers. I'm not telling them about Fannie Mae and Freddie Mac unless I have an investor who loves finance and they like to
Mhm.
chit chat with me. Will I get into it? But yeah, um,
Gotcha.
the the other reason I brought this up, the cycle is important. Is as you can see, there's a lot of people involved in the life of a loan before it winds up, between borrower to 401k on Wall Street. Because of that, that is why you would see a federal uh, funds rate, the Fed rate, the rate that the government is putting out there that they're charging to banks to loan money. I think it's currently at 1.75%. I think I sent that to you yesterday. Why are interest rates at 6% if the government's only requiring 1.75%? Well, everywhere along the way, there's an entity taking a little bit off the top. So that's how you wind up with, because everyone that touches hands wants to be paid. So, Fannie Mae takes a little bit, the servicer takes a little bit, the mortgage company takes a little bit. And eventually that's how we end up with these interest rates. And if you ever hear us refer to points, means you're paying a small fee at closing in exchange for a lower interest rate. It also works in the other direction, just in case your buyers are ever curious. They can take a higher interest rate to get a lender credit, where we'd give them money off of their closing costs. That being said, how do we come up with these numbers? How am I telling someone, well, you can get 5.75% if you spend a quarter of a point? And he goes, what does that mean? Like, how did you even come up with that? This is how. Once the government kind of creates this money, they set the baseline of how much it's going to cost, and then from there everyone takes their small cut. It winds up with me out here in the field talking to your buyers, and that's how I can tell them, well, here's the numbers I'm seeing. So just for your knowledge, so because I do talk to a lot of people who they feel like it's almost made up out of thin air. It kind of is a little bit by the government, who sets that rate depending on inflation and unemployment and different economic factors. But how it gets to that final number is basically all these players on the screen right now.
Gotcha. Okay.
Cool. That was just what I should have flipped to the next screen. One thing I would say about Fed funds rate, inflation, purchasing mortgage-backed securities. I didn't mention it earlier, but the one other big entity that the government does to help stabilize and promote the housing market is they will purchase these mortgage-backed securities. So those lumped together mortgages that Fannie Mae and Freddie Mac had, the government itself, as if they haven't had enough influence already, will come in and buy stocks off the market through these mortgage-backed securities. And one reason that interest rates were so wildly low over the last 2 years is that they were buying a ton. They were buying way, way, way more than they ever had before. And because of that, it basically just promoted keeping interest rates low and chugging these out. There's almost a guaranteed person to buy these no matter what. So in the last 6 months, they have said, whoa, 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 we're running it a little too hot. The economy's, looking a little wishy-washy. Inflation's up, gas prices are flying up. We need to get a handle on this. What's the first thing we're going to do? We're going to stop purchasing these mortgages. And they started tapering, is what they've called it. You might see a headline with that out there. And what that means is they basically say, well, next month, we're going to buy 25% less of these than we did before. And what that does to everyone in the market is that, wait a minute, that's 25% less of these that are being purchased. That's basically like, your biggest buyer coming in and saying, guess what, I'm not purchasing anymore, find somebody else. Well, you're the biggest one in the market. So like, that's a huge, substantial number. To offset that, they have to raise interest rates and basically hedge for whatever the future looks like, because the Fed has come in and said, we're kind of throwing you to the wolves, you have to figure it out. So that's why rates went up historically fast. 6% historically is not bad. It was 18% in 1981. Now, how to go from 2.99 to 6% in 6 months? Well, they raised the rate, the federal funds rate, and they stopped purchasing these mortgage-backed securities super, super fast. So let's see here. So all that goes into kind of the biggest point, being that Fannie Mae and Freddie Mac are the big buyers in the market. They're going to buy these mortgages. They will set the guidelines for what it means to qualify for a conventional mortgage. They basically said, we're the ones buying them, we're going to make the rules. So they set the rules out for what minimum credit score, debt to income ratio, down payment, all of that. So I just wanted to kind of touch on those. I did have a handout here. I'll see if I can post it in the chat afterwards, just so you can have it. Or I suppose it's just us. I can try and figure it out real quick here.
Okay.
Here. How do I attach? I might just have to email it to you. What's your email?
It's gonna be ALIZECHERRY@kw.com.
It's called the program cheat sheet, and it's good for more than just conventional. So
Gotcha. Okay.
all right, so on there you'll see, sorry, a little more in frame here. On there you'll see that the minimum credit score is a 620. That's a little bit loaded because you can qualify for conventional with a 620. However, you're going to have to put down a ton. I think it's at minimum 30%. So generally I say more like 680, and I'm more comfortable with conventional when it's over 700. Over 700, you're able to qualify for 5% down. You don't need a ton of reserves. It's a little more slam dunk when you're over 700. Debt to income ratio, what that is your gross debt, or I'm sorry, your gross income that's before taxes minus your monthly debts, including this new house. So your credit card, your car, your investment property, and this new house payment we're working on. That's going to max out at 49.9 in most cases. And if you're shaky on the credit, we might have to go down to just under 45%. And I usually like to walk buyers through that. Even though I know the math is a little confusing for them, it at least lets them know how I'm coming up with that ratio. I'm not just coming up with numbers out of thin air and saying, yep, this is what you qualify for, trust me. You know, I try and let them know it's not an opinion, it's a calculation. Down payment, you could actually do as little as 3% down if you are if you're a first-time home buyer, 5% down for the rest, and then 20% down eliminates PMI. You'll see PMI down there. I have a whole class on PMI. It's a Sean Hadley original, and I recommend it. Next time I have it on the calendar, keep an eye out for it.
Okay.
And then there are loan limits. For conventional, it's 645. I think it's like 646, 200, something like that. But basically 645 is the max you can loan at for conventional. Anything above that, still possible. It's just now a jumbo loan rather than a traditional loan. So first-time home buyer programs, those are called Home Ready, Home Possible. If the buyers take an online course, doesn't take long, it's pretty easy. They get a certificate and email it over to us. They can put as little as 3% down. They can qualify for reduced mortgage insurance and a reduced interest rate. It's a great program. If you qualify for it, I'm pushing everyone that direction. It does have an income limit, but that just went up for Cuyahoga County to $68,000. So that's not bad. It's pretty great. You can make almost $70,000 and qualify for a first-time home buyer program. That's, you know, pretty awesome. And then I have a little bit on, you know, why you'd want to use it, some of the benefits of it, good interest rates, lower PMI with good credit. Some people with an 800 score, they will have mortgage insurance as low as 20 or 30 bucks a month, which, you know, 10 years ago, after the crash, the mortgage insurance didn't exist, and then it slowly came back, but was expensive. You could possibly get an appraisal waiver. So that's one thing. If you have a property that qualifies for an appraisal waiver through the automated underwriting system, basically it just says, hey, we like the numbers, we like the house, no appraisal needed. And that's the happiest call I get to make to people. They love to hear it. Because we don't have to do an appraisal, it's basically balls completely in our court. We can run with the loan as quick as possible, and I've closed loans with appraisal waivers in a week. So wow. It's pretty awesome. It's a smoother overall process generally. You know, FHA and VA are still pretty easy. We still close them in under 30 days, but conventional, you know, if a buyer's got a regular salary W-2 and they've got the funds to close, I've seen loans even with appraisals close in 10 days. Just a very easy product. We do a ton of them, and my processors are super, super good at it. So,
okay.
One thing that I like to throw out there for older buyers, if they've got a bunch of money saved up, you know, in their retirement or investment accounts, and they want to use that money without having to touch that money to qualify, we do have a thing called asset depletion, where we can basically take, you know, whatever money they've got in their savings or retirement, run a calculation on it, and derive an amount of income that we can use to qualify without them having to draw on that account at all. It's pretty awesome. I've helped people buy houses, you know, a ton with this. And they're happy because they don't have to touch the money, which is what they're afraid of doing in the first place. They want to leave it right there in that retirement. So only catch is you have to be over 59 and a half years of age to do that. So it also, conventional loans apply to more properties than FHA and VA. FHA and VA are generally going to be just single family, or I'm sorry, primary residence, and you can do multi-family, but you're still going to have to live in one of the units. With conventional, we can do investment properties, 1 to 4 units, and you can do condos. Condos with government loans like FHA and VA are kind of problematic because they have to be on a pre-approved list. And FHA is really tough. They don't have a single one in all of Cuyahoga County. So,
And when you say they have to be on a list, you mean the condo association has to be?
that's correct. Yes. Yeah. So what we do is we look up the condo association for the specific property and see if it's on the approved list. If not, we're basically out of luck. I've heard some crazy stories where people have, tried to get them put on there. I don't even know how you'd start that process. And at the very least, I think it's going to take a while, maybe months. I don't know if the sellers would, want to wait around. So for the most part, if you're looking at a condo, we're probably going to look conventional. So any questions?
No.
I appreciate it. I hope it wasn't too behind the curtain.